We will not raise interest rates preemptively because we think employment is too high, because we fear the possible onset of inflation. Instead, we will wait for actual evidence of actual inflation or other imbalances.
Now I want to turn to the inflation crisis that we're seeing. As you can see right behind me, we've seen a dramatic increase in the cost of many household items, everyday items that families buy. Milk up 5%, bacon up 13%, gas up 56%, used cars up 30%, as we're seeing a shortage of products, harder for people to get products, supply chain backups, harder to get workers. We're seeing, as the result of that, about a 5% inflation rate recently. So I would ask you, Chairman Powell, is 5% inflation acceptable to you?
No, it's certainly not.
I strongly believe that the recent spike in inflation will only be temporary, and that shouldn't cause the Fed to raise interest rates too soon.
A pretty substantial part, or perhaps all, of the overshoot in inflation comes from categories that are directly affected by the reopening of the economy, such as used cars and trucks in particular. There's sort of a perfect storm of very strong demand and weak supply due to the reopening of the economy and various factors. We see airplane tickets, we see hotel prices, we see other things. I will say that these effects have been larger than we expected, and they may turn out to be more persistent than we've expected. But the incoming data are very much consistent with the view that these are factors that will wane over time, and that inflation will then move down toward our goals, and we'll be monitoring that carefully. Of course, we're prepared to use our tools as appropriate if that turns out not to be the case, to guide inflation to 2%.